Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 332 on July the 19th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Lucid Group Inc., Ford Motor Company, and the VanEck Junior Gold Miners ETF. And we discuss three new trades on Medical Properties Trust, Robinhood Markets, and Marathon Digital Holdings. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity market saw mixed results this week. The Dow Jones Industrial Average gained 286 points, closing at 40,287 points. The S&P 500 index lost 110 points, ending the week at 5,505 points. This highlights the reason why it's so important to understand the components of the major indexes before you trade them. The S&P 500 is much more tech-heavy right now compared to the Dow Jones Industrial Average. And now it's time for the topic of the week. The topic of the week is expiring options. And since today is options expiration for monthly options in July, I figured it was a good time to give a review of what happens to options at expiration. Now, I've also heard from a few people via email who could use a refresher on expiration. So here goes. The stock options that we trade represent 100 shares of stock at a given price. That price is the strike price. And when the stock price finishes higher than the strike of a call option, that option is considered being in the money. And since puts represent selling 100 shares of stock, when the stock price is less than the strike of a put option, the put option is in the money. Now, when a call option expires in the money, the buyer of the option has the right to buy 100 shares of stock at the strike price. And because the strike price is less than the current price of the stock, the position is profitable for the buyer of the call option. If you sold the call option, you now have the obligation to deliver 100 shares of stock at the strike price. The opposite holds true for put options. The buyer of a put option has the right to sell stock at the strike price of that option. And for the option to be in the money, that means that the stock value is less than the strike price of the option, so it's a profitable position as well. Now, if you sell a put option, you have the obligation to buy shares of stock at the strike price of the put option. This feature of selling put options is one of the reasons why so many investors will sell a put option rather than simply buying stock at the current price. Now, that's all the easy stuff. What happens with the spreads that we trade on the show? Well, it's still pretty easy if you look at it option by option. So if both strikes expire in the money, then the stock position will net out. You'll both buy and sell stock. If the underlying stock expires in between the two strikes of your spread, you'll either have rights or you'll have obligations, depending on whether you bought or sold the spread. Just look at the individual options that are involved to figure out what the result will be. And finally, it is important to consider your post-expiration position. The option positions will disappear from your account, and you'll be left with a stock position instead. You want to make sure that you're aware of any stock positions that result from your option trades. Not handling the stock immediately can actually lead to losses well beyond the profit from the option trade itself. Now, if you have any questions or need additional help with expiration, shoot me an email. We can definitely hop on a phone call and talk through it. It's pretty simple after you've done it a few times, but it can be a little bit tricky those first couple of times. All right, so that's it for the topic of the week. Let's go ahead and get into the trade review from last week's trades. We're going to start off with the covered call on Lucid Group Inc. symbol L as in Lima, C as in Charlie, I as in India, D as in Delta. At the time, the stock was trading for $4.25 per share. I looked at buying stock and selling the August 4.5 call at 51 cents, hoping for a return of 17.88% in 5 weeks. Well, shares of Lucid Group lost 75 cents, ending the week at $3.50 per share. The call option that we sold lost 34 cents, leaving us with a net loss on the week of 41 cents if we were to close the trade out immediately. Now, we are 24 cents below the break-even point right now, well within reason to make an adjustment. You can roll the strike of the call option lower. Now, my goal in doing this is typically to cover the upfront loss from the week and ideally to leave some chance of a profit. The only strike that will allow that right now is selling the 3.5 strike at 44 cents. That would also essentially cap us out with an implied total profit of 3 cents on the trade. That's 73 cents less than we originally hoped for. Now, I don't like that so much, so I looked at the other strikes. If you roll down to the $4 strike, the premium collected won't cover the loss from the week. However, the upside left on the stock would provide some additional profit potential. Even with the stock being 24 cents below the break-even point, I would lean towards waiting a day or two before making an adjustment just to see if the stock is going to be, if it's going to remain lower or if it's going to rebound higher. We're still 4 weeks away from expiration, so we have a little bit of time on this to design the good or the best next trade. Just always make sure you do the math. All right, next up, you've got the credit spread on Ford Motor Company, symbol F as in Foxtrot. At the time, the stock was trading for $14.01 per share. I looked at selling the August 14-13 put spread at 35 cents, which could give us a maximum possible loss of 65 cents per spread. Well, shares of Ford lost 3 cents, ending the week at $13.98 per share. It's essentially unchanged. The out-of-the-money put spread that we sold is still out of the money. We obviously want the stock to go higher on this trade, and seeing it go lower, even a small amount, is worth noting. Still, we're 33 cents above our break-even point, so the trade is still making a positive return for now. I'll definitely have to keep an eye out on this one in the coming weeks. This is yet another reminder that option trading is not passive. You must watch your positions because they can turn on you at any point. All right, our final trade from last week is a debit spread on the VanEck Junior Gold Miners ETF, symbol G as in Golf, D as in Delta, X as in X-ray, J as in Juliet. At the time, the stock was trading for $47.59 per share. I looked at buying the August 46-47 call spread for 64 cents, hoping for a maximum gain of 36 cents, or that's a 56.25% return in 5 weeks. Well, shares of GDX lost $1.65 per share. The in-the-money call spread that we bought is now fully out of the money. Now, you could close this trade out and take a 24-cent loss, which is 37.5% loss on your capital for the week. Now, I could also turn this trade from a long spread into a short one by selling the 46-48 call spread at 74 cents. That would change the risk on the new position, so you have to do the math because you're going to be left short the 47-48 call spread. Now, all in, you will have sold it for 10 cents, leaving you with another 90 cents of possible loss on this position. I don't like that at all. So I could also look to add a short iron condor by selling a higher call spread and a lower put spread. While that would offset the short-term loss on the trade, it would also increase the amount of risk on the position significantly because that's not adding an iron condor to this trade would not be offsetting. It would actually simply be adding a second trade on top of a trade that isn't working out just yet. So you definitely want to keep that in mind. With 4 weeks left, I would either look to hold the trade and see if the stock is going to move higher again this week, or I would simply close the trade outright and move on to the next trade. It all really depends on your risk tolerance and the amount of capital that you have for trades, and also sometimes the number of trades you have in your position. If you're the kind of person that has 5 to 10 trades going on, you might want to close this one. If you're the person that chooses one trade and follows it through before you move on to the next, well, it's not as easy a decision. You're going to have to take a look and see what works out best for your own portfolio. So that's it for the trade review. Last week's trades, bit lackluster, but that's okay. It was bound to happen. I've had some pretty nice weeks of return over the last few months, so not hurting too much. Today, July 19th, was option expiration for all July monthly option positions. The trades presented on today's show will all use the August 16th expiration date for monthly options in the month of August. Let's get started with our covered call. I'm looking at Medical Properties Trust, symbol M as in Mike, P as in Papa, W as in Whiskey. The stock ended the week at $4.80 per share. I'm looking at buying stock and selling the August 5 call at 33 cents, hoping for an 11.04% return in 4 weeks. Now you enter this trade by buying stock for $4.80 and selling the August 5 call at 33 cents. This trade makes the most money if stock prices finish above $5 per share. The break-even price is $4.47 per share. In real terms, the stock purchase will require $480 and you'll collect $33 for selling the option. Next up, we have the credit spread. I'm looking at Robinhood Markets, symbol H as in Hotel, O as in Oscar, O as in Oscar, D as in Delta. Stock ended the week at $23.41 per share. I'm looking at selling the August 22-21 put spread at 36 cents, which could give us a maximum possible loss of 64 cents per spread. Now you enter this trade by selling the August 22 put at $1.52 and concurrently buying the August 21 put for $1.16. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $22 per share. The break-even price on this trade is $21.64 per share, and in real terms, you'll collect $36 per spread that you sell and have $64 at risk. And then our final trade on the week is going to be a debit spread on Marathon Digital Holdings, symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. The stock ended the week at $24.73 per share. I'm looking at buying the August 23-24 call spread for 65 cents. That could give us a maximum gain of 35 cents, or that's a 53.85% return in 4 weeks. Now you enter this trade by buying the August 23 call for $4.15 and concurrently selling the August 24 call at $3.50. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $24 per share. The break-even price on this trade is $23.65. In real terms, you'll pay $65 to enter the spread, and your maximum gain is $35 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for subscribing and sharing this with friends. As I mentioned on last week's show, I'm going to be creating a Facebook group. So if you guys are interested in being part of that Facebook group, why don't you email me your Facebook email address, the email address that's tied to your account, and I'll go ahead and send you over an invitation as I build it out so you can be the first members of the community. So, hey, thanks for listening. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.